Welcome to a brand new episode of History Glitch. Today we are moving away from sinking ships and exploding nuclear reactors to examine a different kind of disaster, one that wasn't caused by a mechanical failure, but by human greed, spreadsheet engineering, and a corporate culture built entirely on smoke and mirrors. We are looking at the rise and catastrophic fall of Enron, immortalized in the definitive book The Smartest Guys in the Room by Bethany McLean and Peter Elkind. To understand the Enron glitch, you have to understand how the corporate world worked in the late 1990s. Enron started out as a traditional natural gas pipeline company based in Houston, Texas. It was boring, stable, and predictable. But boring doesn't make Wall Street billionaires overnight. Enter Jeffrey Skilling, a Harvard Business School graduate and management consultant who joined Enron with a revolutionary, highly disruptive idea. What if energy wasn't a physical commodity you shipped through pipes, but a financial asset you could trade like stocks or bonds? Skilling wanted to deregulate the energy market and turn Enron into an energy broker. He brought in a brilliant, ruthless, and deeply corrupt executive named Andrew Fastow, and together they completely re-engineered the company's operating system. They convinced Wall Street that Enron was no longer an old-school pipeline utility, but a high-tech, high-growth financial powerhouse, and Wall Street fell in love. Enron's stock skyrocketed, making its top executives some of the wealthiest and most celebrated men in corporate America. They genuinely believed they were the smartest guys in the room. The core of the Enron glitch, the foundational system error that ultimately killed the company, was an accounting method called mark-to-market accounting. Traditionally, companies account for revenue when they actually receive the cash. But Skilling received special permission from the U.S. Securities and Exchange Commission to use mark-to-market accounting for Enron's trading business. Under this rule, the moment Enron signed a long-term contract, it was allowed to estimate the total future profits of that contract and log them immediately as present-day income on its balance sheet. If the actual profits from the deal turned out to be lower down the road than estimated, Enron didn't report a loss on its earnings statement. Instead, they hid the losses in complex shifting accounting ledgers. This meant Enron's financial reports were completely detached from reality. They weren't reporting what they had, they were reporting what they hoped to make, or worse, what they needed the numbers to look like to keep Wall Street happy. Enron became a massive fiction factory, printing billions of dollars in imaginary profits. As long as Enron kept growing and its stock price kept rising, the system held together. But behind the scenes, many of Enron's actual trading ventures, like an ambitious broadband trading network and international power plants, were bleeding money. Millions of dollars were disappearing into failing projects. To hide these catastrophic losses from public view, Andrew Fastow engineered a masterpiece of financial deception, a web of thousands of off-the-books special-purpose entities, or shell companies, with whimsical names derived from Star Wars and science fiction like Jedi and Raptor. Here is how the scam worked. Enron would transfer its failing assets and bad debts to these shell companies, which were supposedly independent. Then Enron would use its own inflated stock as collateral to guarantee loans for these entities. Because the shell companies were technically separate on paper, Enron didn't have to report their massive debts on its own balance sheet. It was the ultimate corporate shell game. Fastow and other Enron executives were even running some of these shell companies themselves, secretly making millions of dollars in personal profits off transactions with the very corporation they worked for. It was a blatant conflict of interest on a staggering scale, insulated by a culture of absolute arrogance. Inside Enron, a brutal corporate Darwinism was enforced to maintain the illusion. Jeffrey Skilling instituted a policy known as the rank and yank system. Every single year, employee performance was evaluated and the bottom 10% were ruthlessly fired, regardless of how well the company as a whole was doing. This created an atmosphere of extreme paranoia and cutthroat competition. Employees quickly learned that questioning corporate strategy, reporting accounting anomalies, or showing any sign of doubt was a ticket to termination. Dissent was entirely purged from the system. Everyone played along because the stock options were making them rich, and anyone who looked too closely was pushed out. By the year 2000, Enron was a ticking time bomb. The dot-com bubble burst, the broader economy slowed down, and many of Enron's secret shell companies began to collapse under the weight of their own debt. The cash simply wasn't there to back up the fictional profits. Bethany McLean, then a young journalist for Fortune magazine, published a groundbreaking article titled, "Is Enron Overpriced?" She looked at Enron's public financial statements and realized a terrifying truth. Nobody could figure out actually how Enron made its money. The math didn't add up. When financial analysts and journalists started asking basic questions, Enron's leadership didn't provide transparency. They launched aggressive counterattacks. Jeffrey Skilling famously insulted a Wall Street analyst on a public conference call, calling him an asshole for questioning the company's opaque accounting. But the system was already fracturing. In August 2001, under mounting pressure and facing personal burnout, Jeffrey Skilling suddenly resigned as CEO after holding the job for only 6 months, sending shockwaves through the market. Shortly after Skilling's departure, an anonymous whistleblower within Enron, an executive named Sharon Watkins, sent a confidential memo to the company's founder and chairman, Ken Lay. Watkins bluntly warned Lay that Enron was sitting on an accounting time bomb and might implode in a wave of financial scandals. Ken Lay commissioned an internal law firm review, but chose to do nothing meaningful to fix the underlying rot. The end came with terrifying speed. In October 2001, Enron announced a staggering $638 million third-quarter loss, driven largely by the unwinding of Fasto's secret off-the-books partnerships. Shortly after, the SEC officially launched a formal investigation into the company's accounting practices. As the true scale of the deception was exposed to the public, investor confidence evaporated overnight. Enron's stock price plummeted from a peak of around $90 a share to less than $1. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection, at the time the largest corporate bankruptcy in American history. Thousands of loyal employees lost their life savings, which were heavily tied up in Enron stock, and their jobs, while top executives walked away with hundreds of millions of dollars they had cashed out before the collapse. Subsequent criminal investigations led to federal convictions for both Jeffrey Skilling and Andrew Fasto, while Ken Lay died of a heart attack before his sentencing could be finalized. The story of Enron is the ultimate corporate history glitch. It teaches us a grim lesson about the dangers of unchecked institutional arrogance and a culture that worships metrics over truth. The smartest guys in the room built a machine designed to fool the world, but in the end, they fooled themselves into believing that reality could be rewritten by a spreadsheet. Make sure to hit that subscribe button for more explorations into the moments when human systems, logic, and institutions completely crash.